Hi everyone. Today I will be briefing about NPV. So first let us know what NPV stands for. NPV stands for net present value. In finance, NPV is the difference between the present value of cash inflows and the present value of cash outflows over a period of time. NPV is the capital budgeting and investment planning to analyze the profitability of a projected investment or a project. Present value is the current value of a future sum of money on streams of cash flows given a specified rate of return. NPV is an investment criteria that helps the company in accepting or rejecting the investment proposal. Next, in other words, the net present value NPV is a method that is primarily used for financial analysis in determining the feasibility of investment in a project or a business. It is the present value of future cash flows compared with the initial investment. If NPV is positive, then accept the investment proposal. If NPV is negative, then reject the investment proposals. We have a formula to calculate the NPV. So the NPV is equal to sum of present value of cash outflows minus sum of present value of cash inflows. Next, now let us understand the NPV. NPV actually shows the net present value of the investment project of a company. It basically helps the company in deciding whether the project should be accepted or rejected based on certain criteria. I will also explain about the criteria in the next slide. So first, let us know what an actual NPV is. NPV looks to assess the profitability of given investment on the basis that a dollar in the future is not worth the same as the dollar today. Money loses value over time due to inflation. However, a dollar today can be invested and earn a return, making its future valuable possibly higher than NPV seeks to determine the present value of an investment's future cash flows above the investment's initial cost. The discount rate element of the NPV formula discount is the future cash flows of the present day value. If subtracting the initial cost of the investment from the sum of the cash flows in the present day is positive, then the investment is worthwhile, otherwise vice versa. Next, there are certain acceptance and rejections criteria of NPV. In case of an independent proposal, if NPV is more than 1, then accept the investment proposals. If NPV is less than 0, then reject the proposal. If NPV is equal to 0, then depending on the requirements and strategies of the management, the decisions can be taken. There are certain rules to be followed for NPV. The rules are: the net present value rule is the idea that the company, managers, and investors should only invest in projects or engage in transactions that have a positive net present value. Should avoid investing in projects that have a negative net present value. In simple terms, the main rule of NPV is that the investor should invest in the projects where NPV results in positive, and investors should avoid investing in the project where the NPV is negative. Now, let us know the advantages and disadvantages of NPV. The advantages of net present value includes the fact that it considers the time value of money and helps the management of the company in the better decision making. The main reason in a company is that NPV helps the management to make a wise decision of the investment proposals. And there are also certain disadvantages of NPV. The disadvantages of net present value includes the fact that it does not consider the hidden cost and cannot be used by the company. The hidden costs are insurance, legal fees, taxes, administrative fees, etc. Let's talk about the time value of money and NPV. Time value of money refers to the money which you have now is more valuable and now that you will be having in the future. The money you have now is more worth than the money you will have in the future due to its potential earning capacity. Any amount of money is worth more than the sooner it is received. Let us know, and time value of money is based on the present value and future value. Present value can be calculated by cash flows divided by 1 plus r to the power n, where r stands for rate of return and n stands for the time period. Future value is equal to principal plus n into r, that's where P stands for principal, n stands for number of years, and r stands for interest rate. There are reasons for NPV. The first reason being the money you now give you an opportunity to earn, whereas the money which you have in the future might or may not give you the opportunity to the earn. The second talks about the money value changes due to inflation. It is never constant. The money which you will have in future will get reduced on revaluation account of inflation. Now let us know about NPV with an example question. First, let me read out the question for you. X Limited has identified two investment exclusive. The two investment proposals are the projects are Project A and Project B, which requires an investment of 10 lakhs for Project A and investment of 12 lakhs for Project B. And the life of both the projects is 5 years. Project A requires additional working capital of 2 lakhs in the beginning of the year, and this working capital can be recovered in the third year of the project's life. And in Project B requires working capital of 2 lakh in the beginning, which can be recovered at the end of 5th year. The terminal value of Project A is 1,50,000 and the terminal value of Project B is nil. Further, the details of cash flows for each project is given. For Project A, the cash flows are 2 lakh, 3 lakh, 4 lakh, 2,50,000, 2 lakh. Whereas for Project B, it is 2 lakh, 2 lakh, 4 lakh, 3 lakh, 2,50,000 and 2 lakhs. The cost of capital is 10%. Now we are supposed to advise the company basis on the NPV whether the project should be accepted or rejected. Let us solve the problem. First step one being the computation of cash outflows. For Project A, first take the cost, that is 10 lakhs, add along with the working capital, that is 2 lakhs, and sum of the investment comes to be rupees 12 lakhs. Similarly, for Project B, if the cost is 12 lakhs and if we add working capital of 2 lakhs, the investment sum up to be 14 lakhs. So now let us compute the NPV for Project A and Project B separately. Cash flows. The format is cash flows. It is determined with A and the discount factor at 10%, which is B, and present value of cash flows, that is C, is equals to A into B. The cash flows for the first year is 2 lakh, second year is 3 lakh, third year is 4 lakh, third year again, that is recovery of working capital, is 2 lakhs, fourth year is 2,50,000, fifth year is 2 lakhs, and again the end terminal value, that's the last end, is 1,50,000. The discount factor, as shown below, the discount factor can be calculated by 1 divided by 1 minus r to the power n, where r is equals to 10. So 2 lakh and the discount factor at 10% gives up to be 0.909. Second year it is 0.826. Third year it is 0.751. Again third year it is 0.751. Fourth year is 0.683. Again fifth year it is 0.621 and the last is 0.621. Now the present value of cash flows is equals to cash flow into discount factor, that is 2 lakh into 0.909, which is 1,81,800, and second year it is 2,47,800, 3,04,000, 1,50,200, 1,77,50, 1,24,200, 93,150. The total present value of cash flows for Project A is 12,68,300. Similarly, while calculating for Project B, the cash flows are 2 lakh, 4 lakh, 3 lakh, 2 lakh 50, 2 lakh, and 2 lakh. The discount factor at 10% is being 0.909, 0.826, 0.751, 0.683, 0.621, and 0.621. The present value of cash flows is equals to cash flows into discount factor. That is 1,81,800, 3,34,400, 2,25,300, 1,77,50, 1,24,200, 1,24,200. The total sum of present value of cash flows of project B is 11,56,650. Let us compute all this and then calculate the results. NPV is equals to sum of present value of cash inflows minus sum of present value of cash outflows. For project A, NPV is equals to 12,68,300 minus 12 lakh, where therefore the NPV is equals to rupees 68,300. Similarly, for project B, NPV is equals to 11,56,650 minus 14 lakhs. Therefore, NPV is equals to minus rupees 2,43,350. Now, let us summarize this. As a result, project A and project B, the NPV is 68,300 and minus 2,43,350. Therefore, a company should decide in accepting the project A investment proposal and rejecting the project B's investment proposal, has project A has a positive result and project B has a negative